If you look at the world in 2025, one nation still appears to tower above all others. That nation is the United States of America. On paper, it is a colossus. It commands the largest military in human history. It operates hundreds of bases across the globe. Its defense budget exceeds that of the next several nations combined. It issues the world's primary reserve currency. The dollar dominates global trade settlements. Oil contracts are priced in it. Central banks hold it in their vaults. Its technology companies shape the digital world. Its universities train global elites. Its cultural exports define modern life. It looks like the ultimate expression of capitalist democracy. It looks permanent. It looks unshakable. But appearances can deceive. Empires often look strongest just before they weaken. To understand what is happening, you must stop looking at the surface. Stop looking at aircraft carriers. Stop looking at stock market highs. Stop looking at headlines about trillion-dollar tech valuations. Instead, look at the operating system underneath the empire. Look at how the system actually functions. Look at what it produces. Look at how it sustains itself. When you strip away the symbolism, a different picture appears. You do not see an industrial powerhouse. You do not see a nation that dominates global manufacturing. You do not see a country that produces the majority of the goods it consumes. Instead, you see a financialized economy. You see a structure built on leverage and monetary privilege. You see an empire dependent on one critical advantage. That advantage is the global reserve status of the dollar. This is the foundation. Without it, the system changes completely. In 2000, the dollar made up roughly 71% of global foreign exchange reserves. In the late 1970s, it was above 80%. By 2024, that share had fallen to around 58%. The decline has been steady. It has not reversed. Most Americans do not understand what this number means. Reserve currency status is not symbolic. It is functional. It allows the United States to print money that the entire world needs. It allows persistent trade deficits without immediate collapse. It allows the government to borrow at scale. It allows consumption beyond production. It allows an empire to finance itself without matching output. This privilege is extraordinary. No other country in modern history has held it at this scale for this long. But privileges in geopolitics are not permanent. They are sustained by trust and necessity. When trust erodes, systems shift. When necessity declines, alternatives emerge. The American economy today is not the industrial machine that won the Second World War. It is not the same system that built steel plants, shipyards, and mass manufacturing complexes across the Midwest. It has transformed. Manufacturing as a share of GDP has declined significantly over decades. Finance has expanded. Services dominate output. Asset prices drive perception. Growth increasingly depends on credit expansion. Wall Street's influence has grown alongside this shift. The economy became optimized for financial returns. Short-term gains often outweighed long-term industrial strategy. Stock buybacks became common. Corporate leverage increased. Production moved offshore in search of lower costs. This was described as efficiency. It was described as globalization. It was described as progress. Consumers benefited from cheaper imported goods. Corporations benefited from higher margins. Shareholders benefited from rising equity prices, but something else was happening beneath the surface. Industrial capacity eroded. Supply chains stretched across continents. Critical components became dependent on foreign producers. Domestic resilience weakened. The shift was gradual. It did not trigger panic. Asset markets were rising. Technology innovation accelerated. Credit was abundant. Interest rates remained low for long periods. Debt expanded at both public and private levels. Federal deficits became routine. Balanced budgets disappeared after the early 2000s. The national debt rose into the tens of trillions. Servicing that debt became increasingly expensive as rates rose. Yet the system continued functioning because global demand for dollars remained strong. Foreign central banks bought U.S. Treasury securities. Global trade relied on dollar settlement. Energy markets were priced in dollars. The feedback loop sustained itself. America consumed. The world exported. Dollars flowed outward. Treasuries flowed inward. The cycle appeared stable. But stability in finance often masks fragility. If the rest of the world gradually reduces dollar dependence, the dynamic shifts. If countries diversify reserves, demand softens. If alternative settlement systems expand, exclusivity declines. This process does not happen overnight. It unfolds slowly. Then it reaches a tipping point. History offers examples of reserve currencies losing dominance. The British pound once held global reserve status before the mid-20th century. After the Second World War, its influence declined. The transition was not immediate, but it was decisive. Power structures adjusted, economic leverage changed. The United States rose in that era because it combined industrial dominance with monetary credibility. Today, the question is different. Can a country remain financially dominant without comparable industrial weight? Can monetary privilege alone sustain global primacy? Can debt expansion continue indefinitely without consequence? These are structural questions, not emotional ones. They are about arithmetic. They are about production versus consumption. They are about reserves versus liabilities. They are about trust. If trust weakens, the adjustment can be abrupt. If foreign buyers reduce treasury purchases, yields rise. If yields rise, debt servicing costs accelerate. If costs accelerate, fiscal flexibility shrinks. The illusion of strength can persist for years. Markets can rally even as imbalances grow. Political leaders can claim resilience. Commentators can highlight GDP totals and military capacity. But beneath those signals lies the operating system. And that operating system depends on continued global dollar demand. If that demand declines meaningfully by the early 2030s, the adjustment will not be cosmetic. It will be structural. It will force trade rebalancing. It will force fiscal reconsideration. It will test social stability. The narrative of permanent dominance assumes continuity. The data suggests transition. Empires rarely announce their decline. They often dismiss it. They focus on visible power. They underestimate structural shifts. The United States remains powerful in 2025. That is undeniable. The deeper question is sustainability, and sustainability depends on foundations, not appearances. Part 1 ends with this central tension. The world still sees a superpower, but the underlying system is changing. To understand how the foundation began to crack, we must go back to 1971. The year is critical. The system that governed global money after World War II was under pressure. That system was created in 1944 at the Bretton Woods Conference. Under Bretton Woods, the dollar was pegged to gold at $35 per ounce. Other currencies were pegged to the dollar. Foreign central banks could exchange dollars for gold. This arrangement gave the dollar credibility. It was not just paper, it was convertible, it had an anchor. For decades, this system worked because the United States held the majority of the world's gold reserves. It also possessed the largest industrial base on Earth. After the war, Europe and Japan were rebuilding. America was producing. Exports were strong. Confidence was high. But by the 1960s, cracks began to appear. The United States was running budget deficits. It was funding the Vietnam War. It was expanding domestic social programs. Dollars were flowing overseas in large quantities. Foreign governments accumulated those dollars. They began to question whether the U.S. had enough gold to honor conversion requests. The arithmetic became uncomfortable. America had printed more claims on gold than it physically possessed. Countries such as France started redeeming dollars for gold. Gold reserves at Fort Knox declined steadily. Pressure mounted. President Richard Nixon faced a dilemma. He could defend the gold peg and risk exhausting reserves, or he could suspend convertibility. On August 15, 1971, he chose suspension. He announced that the United States would temporarily close the gold window. Temporary became permanent. The dollar was no longer backed by gold. It became a pure fiat currency. This decision transformed the global monetary system. For the first time in modern history, the reserve currency was backed solely by confidence. There was no metal anchor. There was no redemption mechanism. There was only trust in American power and stability. Under normal circumstances, this shift could have caused a collapse in demand for dollars. Why hold paper with no intrinsic backing? Why rely on a currency that can be expanded without constraint? But the United States had geopolitical leverage. In the early 1970s, another development changed everything. The global oil market was reorganizing after the oil shocks. Energy demand was universal. Oil was essential for every industrial economy. A strategic agreement emerged between Washington and Riyadh. Saudi Arabia would price oil exclusively in dollars. In return, the United States would provide military protection and security guarantees. This arrangement became known as the petrodollar system. It replaced gold with oil as the implicit support mechanism for the dollar. If every country needed oil, and oil was priced in dollars, then every country needed dollars. This created structural demand. Central banks held dollars not for gold conversion, but for energy security. Trade deficits became manageable because surplus countries recycled dollar earnings into U.S. treasuries. America could import goods and export currency. Foreign nations accumulated reserves and invested them back into U.S. debt markets. The cycle deepened financial integration. The Federal Reserve gained greater flexibility. Money supply expansion was no longer constrained by gold holdings. Credit could grow more freely. Financial markets expanded. Over time, Wall Street's influence increased. The economy became increasingly centered on finance rather than production. Deregulation accelerated in the 1980s and 1990s. Banking rules loosened. Capital markets globalized. Leverage became easier to obtain. Complex financial instruments proliferated. Derivatives markets grew into the trillions. Corporate behavior shifted accordingly. Executives prioritized shareholder returns above industrial investment. Stock buybacks became common. Production migrated to lower-cost regions abroad. Global supply chains optimized for efficiency, not resilience. The United States consumed more than it produced. Trade deficits widened year after year, yet the dollar remained strong because global demand persisted. As long as oil and trade required dollars, the system sustained itself. But reliance on a single privilege introduces vulnerability. If oil pricing diversifies, demand shifts. If geopolitical rivals create alternative payment systems, dependency declines. If sanctions weaponize currency access, trust erodes. In recent years, these pressures have intensified. Major economies have explored settling trade in local currencies. Energy transactions have gradually expanded beyond exclusive dollar pricing. Central banks have increased gold purchases. Digital payment infrastructures are evolving outside traditional Western channels. None of these shifts immediately dethrone the dollar, but they signal diversification, and diversification reduces monopoly power. Meanwhile, federal debt in the United States has continued to rise. Interest costs have climbed alongside higher rates. When borrowing expands faster than production, sustainability depends on continued confidence. Confidence, however, is psychological. It can weaken quietly. The post-1971 system functioned because the United States combined military strength, economic scale, and financial credibility. The question today is whether those pillars remain equally strong. Military capacity remains formidable, financial markets remain deep and liquid, but industrial dominance is no longer absolute. China has become the world's largest manufacturer by output. Supply chains increasingly reflect Asian production capacity. Trade patterns are more multipolar. If the dollar's share of reserves continues declining over the next decade, the consequences will not be symbolic. They will affect borrowing costs. They will affect exchange rates. They will affect living standards. The shift that began in 1971 removed the gold constraint. For decades, that flexibility enabled expansion. It enabled stimulus. It enabled crisis response. It enabled asset inflation. But flexibility without discipline can accumulate imbalance. The foundation changed in 1971. The effects took decades to surface. Now the system faces a new phase. The petrodollar arrangement that replaced gold is no longer unquestioned. The global economy is more fragmented. Trust is more conditional. The privilege that sustained deficits for half a century is no longer absolute. Part 2 ends here. The break in the foundation occurred decades ago. Its consequences are unfolding now. After the gold anchor was removed and the petrodollar system stabilized demand, a new phase of the American economy accelerated. That phase was financialization. Financialization means the increasing dominance of financial markets, financial institutions, and financial motives over the real economy. It is not simply banking. It is the transformation of the entire economic structure around asset prices and credit expansion. In 1950, the financial sector was a small portion of total output. Banks primarily took deposits and made loans. They funded factories, infrastructure, and productive enterprise. By the early 21st century, finance had expanded dramatically. Trading, derivatives, asset management, and complex securities became central profit engines. Finance grew faster than manufacturing. Profits concentrated in financial hubs such as New York. Compensation in the sector soared. The cultural center of economic ambition shifted from building things to structuring deals. This transition was reinforced by policy. Deregulation unfolded over decades. Capital controls weakened. Barriers between commercial and investment banking eroded. The repeal of key safeguards in the late 1990s allowed consolidation. Banks became larger. They became more interconnected. They became systemically important. When institutions grow too large to fail, incentives change, risk becomes asymmetric. Profits remain private, losses become public. The financial crisis of 2008 demonstrated this structure clearly. Excessive leverage in housing and credit markets triggered collapse. Major institutions required emergency support. Government and central bank interventions stabilized markets. Trillions of dollars in liquidity were deployed. Interest rates were reduced to near zero. Quantitative easing expanded the Federal Reserve's balance sheet dramatically. Asset prices recovered quickly. Stock markets reached new highs within years. Corporate bond markets flourished. Real estate valuations rebounded. But the recovery was uneven. Wealth concentration accelerated. Those who owned financial assets benefited most. Those dependent solely on wages saw slower improvement. Meanwhile, manufacturing continued its relative decline. Factories had already moved abroad in prior decades. Production networks were globalized. Corporate leaders faced constant pressure from shareholders to maximize quarterly returns. Cost-cutting became a standard strategy. Labor was often viewed as an expense rather than an asset. Outsourcing improved margins. Automation reduced payrolls. Communities dependent on industrial employment weakened. Midwestern cities that once produced steel, automobiles, and machinery experienced stagnation. The service sector expanded in parallel. Healthcare, retail, hospitality, and logistics absorbed displaced workers. But service wages often differed from prior industrial pay scales. Job security changed. Benefit structures shifted. Union power diminished. At the macro level, GDP still grew. Consumption remained strong. Credit filled gaps. Households borrowed for homes, education, and consumption. Government borrowing increased to sustain spending. The structure increasingly relied on debt-fueled demand. Low interest rates made borrowing appear manageable. As long as rates remained low and the dollar retained reserve dominance, the system functioned. But leverage builds sensitivity. When rates rise, debt servicing costs increase rapidly. Public debt climbed into the tens of trillions. Corporate debt expanded as well. Household debt fluctuated but remained substantial. Servicing obligations became a significant budget component. Interest payments began competing with discretionary spending. This is where arithmetic becomes critical. If interest consumes a growing share of revenue, flexibility declines. Policy choices narrow. Deficits widen further if growth slows. In such an environment, the central bank faces difficult trade-offs: raise rates to control inflation and risk recession. Lower rates to stimulate growth and risk currency weakness. Either path carries consequence. Financialization also changed corporate behavior in subtler ways. Stock buybacks became common tools for boosting earnings per share. Rather than reinvesting profits into long-term research or domestic expansion, companies frequently returned capital to shareholders. This supported equity valuations. Executive compensation, often tied to stock performance, benefited accordingly. The incentive structure rewarded financial engineering. Meanwhile, global competition intensified. China expanded manufacturing capacity at scale. Infrastructure investment surged across Asia. Supply chains increasingly integrated around East Asian production hubs. The United States remained a leader in technology and services, but its relative share of industrial output declined. Trade deficits persisted year after year. The country imported more goods than it exported. These deficits were financed by issuing dollar-denominated liabilities. Foreign central banks accumulated treasuries. The cycle continued because the dollar remained essential to global commerce, yet structural imbalances accumulated quietly. Dependency on foreign supply chains increased exposure to disruption. Pandemic-era shortages revealed vulnerabilities in medical equipment and semiconductors. Geopolitical tensions highlighted reliance on critical minerals sourced abroad. Rebuilding industrial capacity is possible, but it requires time and sustained investment. Decades of offshoring cannot be reversed instantly. Workforce skills, infrastructure, and supplier ecosystems must be redeveloped. This takes years. It also requires capital allocation decisions that may reduce short-term profitability. In a financialized system optimized for quarterly performance, long-term industrial strategy can struggle to gain traction. Meanwhile, inequality widened, asset ownership concentrated. Stock market gains disproportionately benefited higher-income households. Home price inflation enriched property owners while raising barriers for new buyers. Younger generations faced higher housing costs and education debt. The perception gap widened between headline economic indicators and lived experience. Markets signaled prosperity. Many communities felt stagnation. This divergence affects social cohesion. It shapes political polarization. It influences confidence in institutions. Financialization does not automatically lead to collapse. It can coexist with growth for extended periods. But it shifts the balance between production and leverage. It increases reliance on stable financial conditions. It amplifies the consequences of monetary disruption. If the reserve currency privilege weakens while debt levels remain high, the adjustment becomes more severe. If borrowing costs rise materially without corresponding productivity gains, fiscal strain intensifies. The structure built over 5 decades is resilient in some respects. Capital markets are deep, innovation capacity remains significant, entrepreneurship continues. But resilience depends on adaptability. A system optimized for asset inflation must transition carefully if global conditions change. Part 3 ends with this observation. The American economy did not collapse when it financialized. It prospered in many measurable ways, but it also became more leveraged, more unequal, and more dependent on monetary dominance. If that dominance erodes, the consequences will reflect decades of accumulated structural change. By the early 2000s, America faced a new compounding problem. Debt, not just household debt, not just corporate debt, but federal debt. The United States has not run a budget surplus since 2001. That means over 2 decades of continuous deficits. From the Bush administration through Obama, Trump, and into the Biden years, the federal government spent more than it collected. This trend persisted through war and peace, booms, and recessions. In 2001, U.S. federal debt was approximately $5.8 trillion, or about 55% of GDP. By 2024, debt had skyrocketed to $36 trillion, exceeding 123% of GDP. This is more than a number. It is a structural vulnerability. When debt reaches these levels, servicing costs rise exponentially with interest rate changes. In 2020, interest payments on federal debt totaled $345 billion. By 2024, that number jumped to $892 billion. Projections indicate that by 2030, interest costs could exceed $1.4 trillion per year. To put that in perspective, $1.4 trillion exceeds spending on defense or Medicare individually. It would become the single largest line item in the federal budget. This situation is known as a debt spiral. Once a country enters a debt spiral, options become severely constrained. Option 1, default. Simply refuse to pay. Default would immediately destroy confidence in the dollar. Foreign holders of U.S. treasuries would liquidate positions. The dollar would collapse. Imports would spike in price. The standard of living would fall sharply, potentially by 30 to 50% within months. Option 2, austerity. Cut spending dramatically to balance the budget. Without raising taxes, achieving balance would require slashing nearly 1/3 of federal expenditures. Social Security, Medicare, and defense could each be cut by roughly 30%. Politically, this is impossible. Any attempt would provoke severe social unrest. Option 3, inflation. Print money to cover the debt. This is historically the default choice of empires. Empires rarely stop printing. Default is politically toxic. Austerity is socially untenable. Inflation becomes the tool. Inflate the currency. Transfer wealth from savers to debtors, from wage earners to asset owners. This is not theory. It is what the United States is doing now. Since 2008, the Federal Reserve has printed over $8 trillion. The M2 money supply increased by 40% since 2020 alone. Every dollar in circulation buys less than before. Inflation erodes purchasing power. Workers suffer. The wealthy, with stocks, real estate, and other assets, prosper. This is the hidden mechanism of financialization, redistribution through monetary policy. But debt and financialization interact dangerously with deindustrialization. The United States no longer produces many of the goods it consumes. Factories have closed. Jobs have moved abroad. Supply chains are global. The COVID-19 pandemic revealed the consequences. America, the richest country in history, could not manufacture masks, ventilators, or other critical medical supplies domestically. We depended on foreign producers. China, once considered a strategic competitor, became a supplier of essential goods. This dependence is not limited to medical supplies. Critical military components, rare earth minerals, advanced chips come predominantly from abroad. The Pentagon itself reported in 2023 that 80% of rare earth minerals are sourced from China. Taiwan manufactures the most advanced semiconductors, which China aims to control. Without foreign suppliers, American production falters. Industrial sovereignty has been sacrificed for quarterly profits. The middle class paid the price. Factory jobs disappeared. Steel plants in Pittsburgh closed. Auto plants in Detroit shuttered. Textile mills in North Carolina ceased operations. Electronics manufacturing moved overseas. These jobs were replaced by service sector employment. Retail, healthcare, and food service absorbed displaced workers. Pay and benefits were lower. The average manufacturing job in 2000 paid $45,000 plus benefits. The average service job today pays $28,000, often without benefits. The economy traded productive capacity for cheap consumer goods. A television costs less, but a house, healthcare, or education costs more. Deindustrialization does more than reduce wages. It undermines national independence. A country that cannot produce critical goods is not sovereign. America has outsourced both manufacturing and strategic leverage. Debt, financialization, and deindustrialization form a trap. Each reinforces the other. Debt encourages continued currency printing. Currency printing fuels asset inflation, rewarding those who own assets. Deindustrialization ensures the nation cannot quickly respond to shocks. The system is increasingly fragile, yet the dollar's reserve currency status has prolonged the illusion of strength. As long as the world demands dollars, deficits are manageable. Trade deficits are financed by foreign purchases of Treasury securities. This cycle has allowed consumption to continue beyond production. But the world is changing. Dollar dominance is eroding. Central banks are diversifying reserves. China, Russia, and other nations increasingly trade in local currencies. Oil contracts outside the United States are increasingly priced in alternative currencies. Gold purchases are rising rapidly. When reserve currency status declines, the United States loses its ability to export inflation. Debt servicing becomes more expensive. Imports rise. Standard of living falls. The combination of debt, financialization, and deindustrialization becomes acute. Mathematics, not opinion, dictates outcomes. By 2030-2035, current trends suggest America could face a severe economic adjustment. The middle class will bear the brunt. Those with savings, fixed incomes, and dollar-denominated wealth will see purchasing power collapse. Those who own assets in diversified currencies or commodities may be insulated. The financial elite, disconnected from everyday reality, will survive relatively unscathed. For the rest of the population, the decline will feel sudden. It will be rapid, not gradual. Years of accumulated imbalances could unwind in a few short years. The American economy may look strong today, with markets at record highs, but beneath the surface, structural weaknesses have been accumulating for decades. Debt is unsustainable. Industrial capacity is eroded. Financialization amplifies fragility. Reserve currency privilege is declining. These forces converge toward a cliff. Without structural reform or a fundamental shift in global dollar dependence, the risk of a sharp economic contraction grows. The next part will examine the final tipping points, the projected timeline, and what individuals can do to protect themselves.